ऑन करना है।
एक मिनट एक सही है।
आपको म्यूट नहीं भूल गया, म्यूट नहीं।
जी Assalamualaikum. I welcome you all to the corporate briefing session of UBL Bank. This corporate briefing is for the year 2025. And the way we will work this is that we will have a presentation. With us today, actually, we have the president of UBL, Mr. Javed Iqbal. We have our chief financial officer, Manzoor Zaidi, and our chief operating officer, Nawal Shah. We will begin with the presentation by the president of UBL, and after that, we will follow up with the Q&A. Just one housekeeping rule to be aware of. The questions that you wish to ask, please ask them in the chat box. Direct them towards me, Farooq Karim Khan, and we will take the questions from the chat box. So again, we'll begin with the presentation by Mr. Javed Iqbal and then move to Q&A.
Good evening and Assalamu Alaikum. So we are here on another analyst conference, and we understand that a lot of people have got a lot of anxiety about UBL, especially about UAE and our investment book. So we have tried to answer you can say a lot of questions quite upfront. UBL has got a huge amount of floaters. So first I will give you a background why we have got a floaters and how it's important for us. So we are a bank, we do not want to follow a set pattern whether we have to make this much of lending or how much we have to say make investments. We are quite neutral. So lately the spreads on corporate banking have gone really down. So if anyone is aware of you, or you can say, or more of you are aware of it, a lot of transactions are being, you can say, taking place for a tenor of say 7 years, 8 years, 5 years, around 3 month K, 6 months K, plus at a spread of 10 to 15, 20, 25 basis point. So that is the pricing of the risk at this point in time in the 4%. So when you are lending to the government and when you are dealing with the same tenor, so you have to see that what kind of spread should be for there and how profitable it is. So what we chose that we are lending to the government where the commercial risk is nearly zero. And the spread we have got better than many of the corporate transactions that have taken place in the last 1 year. So we have gone through, I mean, just as a sample, we have gone through of all the transactions that have taken place in Pakistan, over $500 billion, where the average spread is barely 30 basis points. And the average tenor is about 8.1 years. So if you look at then you have to see from that perspective. So that's the reason we took a huge position into floaters, especially 10-year floaters. And then we plan to hold these for a very, very long term. Number one. Number two, you have to see it. What is the weighted average maturity for the government of Pakistan? It was 2.2. And probably under IMF requirements, they wanted to increase it. So in two, especially 2 quarters, ending in December 24 and March 25, the government issued a lot of floating bonds, and UBL was one of the institutions that picked up in a huge quantity at a decent spread. Subsequently, we also bought them because the government issue has gone down substantially, and spread went down. So we got more spread as well because we thought again the spreads are great, and that's the reason we are having a lot of these floater bonds, and we plan to hold these bonds till maturity. Majority of the bonds till maturity. We might trade a little bit. We continue to trade, but I think if you ask me, broader objective is to hold them till maturity because these provide a great spreads and our deposits are, you can say, growing at a fast pace. So maybe we have today, we are financing it through OMO borrowing, but there is a possibility in 3 years down the road, we may not be needing OMO as such to finance these things. So our deposits may be enough to finance these things. I think the spreads, which were on December 25 at 0.63, were very reasonable for this kind of, you can say, asset, which has virtually zero risk of default. Only the liquidity is being tied in, and we have excess liquidity in Pakistan. So if we take into account, I think, in my personal opinion, the spread should not be more than 50 basis points. When this war broke, in panic, the rates went up to something like 99 basis points on March 31. Now these have settled back to, at this point in time, 82. And I think, again, it's a short term. We might see them going down further. And then by the way, we are ourselves a buyer at low spreads. We are one of the people who will continue to invest into this area. We are ourselves a buyer. And then the other thing is, if the interest rates go up, whether we would be making a loss, you have to see if the interest rate goes up. Definitely, our spreads are locked for a shorter period of time, and we would make a loss. So all these bonds are, you can say, spread over 6 months. It's not concentrated in a one specific month. It's a spread over a 6 months period of time. So the average duration, depending on when the rates go up, is likely to be somewhere 2 to 3 months. And then you would lose money when the rates are going up, but you make money when the rates would go down. So because these are 8-year tenor, so there is a possibility you lose 2 times going up and then you make money 2 times going down. So again, it's not a major concern. And today, say if the rates go up by 1%, the impact is not going to be more than 8 billion. And I think that's not really looking at our revenues. That's not really a huge amount to absorb. Unrealized gains had gone down on March 31 because I think at that time when the panic was higher. Now I think after 15 days when the things are settling, the spread has come down, as said, in the low 80s, and our post-tax gain on these floaters have gone to about 47 billion. And I think going forward, we do not see much issuance, although we would like a lot more issuance so that we could buy more. But unfortunately, seeing the last 1 year issuance, the issuance is going down, and probably there's more demand for these bonds as well because of kind of a risk-free spread. So the next thing we will share with you is a fixed PIB, and here we have to see 2-3 things together. So how much is available for sale and how much is HTM. So we have shown you the exact numbers. About 69% is available for sale and 31% is an amortized cost. The total duration is about 2.5 years on the fixed bond portfolio. A 1% interest rate change, the impact is 21 billion. So if we will have a negative impact. But I think this is a theoretical maximum. Theoretical maximum means the rate would go up in all durations. So rate will go up less than 1 year by 1%, rate will go up by 1% in 1 to 3 years, the rate will go up by 1% 3 to 5 years and 1% by 5 years. So I think that's not likely to be the case. I think if the rate go up by 1%, the net impact on the back equity post-tax basis is going to be something like 10 to 12 billion. So the 10 to 12 billion is likely to be offset by the gains that we have got the floaters. So I think that at the maximum case, if the rates have to go to say 3 to 4%, and I don't know whether it would go up or not, but I think if the rates were to go up, then I think we have quite a cushion into our floaters. Then another important aspect, we have to discuss how these fixed bonds compare with our current accounts. So if you, I think we will just show you in this sheet, our current account growth has been phenomenal. And then we are going to see something like a very high, hopefully high growth in future as well. We see by June this year, our fixed bond to current account portfolio is going to be the same. So exactly same. So that means even if you can say the rates go up, but our revenues are locked in because these are being funded by our current account. these are sorry for technical. These are being funded by our current accounts. So our you can say both floaters and fixed income, our net interest income is fairly protected. So anything which is you can say impacts rates on, so that will affect our capital, but not our net interest income. Unrealized losses on these bonds have come down to 2.9 billion as of yesterday. And you have to, you can say, understand that this is based on the recent rates. So rates are already, you can say, since February 28, the rates are already up by something like 100 to 150 basis point. So that is covered up. So today our loss is close to 3 billion, but you can say on the other side floaters, we have got a huge gain as well. We believe that our net interest income is not exposed to it, and we are comfortable from that perspective. Now here we have shown you the CAR. Our historical average CAR has been 19%. So it's shown you something like 10-year trend. But I think the average is high because in December 2020, and due to COVID, the dividends were not paid out. So temporarily the CAR went up, so that you can say that has affected the average. We are at close to 17.6%. Our total CAR at this point in time, minimum requirement is 13%. So we have got quite a huge cushion. So our calculations show that any 1% rise in interest rate would impact by our CAR on the total basis around 40 basis point. So maybe 42 or 38. So that's the impact we have calculated. So and already 100 basis point to 150 basis point rise is built, increase is already built into the current CAR. And every quarter, because we are making quite a decent money every quarter, and I said that our net interest income is protected by and large, whether it go up or not, except a small blip due to floaters. So every quarter due to retention, and despite paying out dividend, our retention is likely to be 40 basis point. So if you lose on one side, the only impact could be maybe there is a possibility that in one quarter, if the rates go up, I'm not suggesting the rates are going to rise, but even if the rates rise by 3% or 4%, and then you can say your CAR is impacted, first of all, it is not going to go below, likely to be go below 15% or something like 16%. And then we would be covering back entire reduction in CAR over the next 3 to 4 quarters and without impacting our dividends. So that is the calculation. We are looking into it. And from that perspective, we are reasonably comfortable that we can operate in all kind of scenarios. And then another thing is, let's assume if the rate goes up in this quarter, so what happens 3 quarters down the road? 3 quarters down the road, we will have higher retained earnings, number one, because NII seems to be quite protected. Simultaneously, our duration on fixed bond would have gone down by then as well. So I think we have not brought that calculation into it. But as right now, the duration on the fixed bond is 2.5 years. And I think it's going to go down further in 6 months down the road. So I think that would be again working in our favor. Now, I think a lot of anxiety about the GCC asset book. First of all, I cannot predict the future. Situation is quite fluid. That what happens at the GCC, to be honest, I'm not aware of. We are hopeful and praying that things settle down. But I think as you are all aware, that it is impossible to predict the outcomes in this war kind of situation. So we are looking at what we can control, number one. What we can control, so we will be working on things that we control and be prepared if something goes horribly wrong and understand the situation clearly. So we are, you can say, just waiting you can say how things shape up after the war and when it happens, I cannot guess. Or maybe it happens ends in 2 days, or it ends up in say 2 months. I really don't know. And what would be the impact of that war in terms of destruction at any of the geography we work on? So I really don't know. I cannot comment it. But I think we will first of all look at things from a broader perspective. Number one, the UAE government is fairly rich. They are running huge capital surpluses every year. So they have a huge fund. So I think we have to go back and look at the COVID examples, what they did in COVID. So we feel that once the war settles, that the government of UAE will come back and try to do a lot of stuff. Number one. So I think that's our hope. The other thing is we have shown you the entire portfolio. If you look at our investments, our investments are fairly protected. So we have government bonds, 413 billion rupee, 413 million US dollars. And out of that, $169 million has already been paid because this position is reflective of the March 2026. Since the government of Pakistan, Eurobond exposure, we are comfortable in that. Rest is AAA exposure, so I think we are not worried. And again, it provides a lot of liquidity. If there is some kind of a deposit withdrawal, we are comfortable on that side. And on the similar way, if you look at our advances side, so if you see something like close to, you can say, 56-7%, 58% probably, is into the government of Pakistan, GCC government entities, a financial institution where the exposure is 3 to 6 months, is not really a large exposure. And I think we are very comfortable on this portfolio. The rest is the real estate. How the real estate would behave, again, it all will depend when the war ends and what happens in between. The difference between this time and 2008, what we have seen is this time, a lot of developers are, you can say, financially much stronger than the kind of people we saw in 2008. A lot of people have now got a lot of equity. There's not that much leverage. And the people we have worked with in the real estate, majority of them are, which have, you can say, a high ratio of equity compared to debt. So I think if the things settle down, there will be, in our opinion, slowdown in real estate. But I think we are not seeing any kind of a serious distress if things were to settle in the short term. So I cannot comment on the long term, if what happens and what happens again in that war. So rest of the customers are divided over a very large number of sectors. So I think at this point in time, we are not worried. But again, we are waiting what happens on the GCC, and then we would be able to probably share more with you. But I think at the same time, we have to understand UBL in another perspective. UBL is a bank that has changed over a period of time. In 2021, our total revenues were under 100 billion rupees. In 2025, our revenues are close to 420 billion. And we are expecting similar or better revenues in 2026. So our position is quite strong and we are quite resilient. And then if something to go wrong in UAE, I do not see the provisions coming back in just one year. I think these will be staggered out, and it may be staggered out over 3 years, maybe government helping a lot of people over there. So again, but at the same point, I would say that we are quite comfortable at this point in time and not worried in any aspect. Not overly worried. Yes, we are looking hoping for the early resolution. Now the current deposits, so far we have done very well. I think probably it has never happened in the history of Pakistan that when in a something like this, 39 months, deposits almost tripling. We had a very strong quarter. So we did very well in 2025. We gained a significant market share, about 2.4% market share we gained in 2025 in this current deposit total market, and we have done well in the first quarter. But at the same time, industry is also doing great. Some of our competitors are doing also very great. So we will see how we can perform rest of the year. We're working hard, and then only I think the time would tell how we are able to maintain our growth. We are working hard. That's all I can assure you. We are quite focused on this, but I think only the time would tell whether we can maintain same kind of growth or not. Only time is going to tell. Our total deposits, again, the growth is very high. In total deposits, we do not follow any kind of target for our total. We have no targets. So in the current account, we work hard, but on the total deposits, it all depends whether the deposits that we get out of marginally, you can say are profitable or not, or even the marginally profitable or not. So we do not have any interest in balance sheet expansion at a loss transaction. So we are quite focused. If there is some margin, we will raise money. If there is not, we will not raise money. So we are not really looking into it. There is a possibility our deposits might go down. There's a possibility our deposits might go up. So we are keen on taking deposits, but our rates are competitive. So if we can get the money in those competitive deposits, only then these deposits are profitable. Otherwise, there's no fun in having a lot of deposits where you're not making money or you're making a losses. So we do not follow that strategy. Our strategy is based on making you can say having deposits as long as those are profitable, and we would follow this strategy. We have no ambition to become number one. We do not mind slipping to number 4 in total deposits. So if with the real work and the real deposits come on, we will, you can say, come to our balance sheet. We are very happy. Otherwise, we are very happy without them as well. So we are the market leader in foreign exchange of Pakistan. We were already, you can say, the number one, almost always number one in the remittance market share. We lost some market share. The competition has heated up into this area. So we had 23%. And now maintaining it about 20%. Our trade market share was very low in 22, and now it has gone to 9.6%. Our problem is that we do not have a lot of export refinance limits because over the last 1 decade, we did not really work much onto export for refinance, onto exports. So a lot of those limits went to, you can say, other players. But now, since we are increasing our exports, we hope that we will have a more refinance limits and we will be able to gain more market share of exports. But together with remittances trade, we have we handle a forex volume of about $19 billion US, which is highest in the country. And this is one of our goals is to further increase this forex volume. Now these are the profitability snapshot. The last year was good. This quarter has been great. We proactively generated some capital gains. And so even without that, if you see the net interest income has gone up because of the strong current account growth and the trading positions that we have taken. So that has resulted in a strong growth. Our costs have gone up, but that's you have to pay some time for the growth as well. So that is the cost of growth. Our cost has gone up from 26 to 40. And I think, as I explained earlier, that our revenues of 2026 are likely to be higher than last year. So I think by and large, our revenues are locked in. So we have the fixed bonds which are almost equivalent to the current account. So I think our revenues, we seem to have much more control on the revenues. So I think these are highly likely to be higher than 2025. So these are the numbers I think we sent to the stock exchange. So you must be having all those numbers. You must have gone through these numbers. So there's a balance sheet review, and this is one thing as a CEO, and I'm truly proud of what we have done for the country and for ourselves as well. I can say there was a low economic growth period. So if you see the 23, 24, 25, relatively low economic growth period, and we have seriously contributed to the society, and we are seriously proud of that. We have hired, I think, one of the things which I am truly proud of is the hiring of 6,000 people, and we have hired these people as a permanent employee with the education of just metric or intermediate, and these people are doing brilliantly. So that is our real contribution to the society. We have generated a lot of employment during this time, and we are the largest private sector white-collar employer. So that is truly a proud moment for us. So now we are open to Q&A. So over to you. Thank you.
Thank you, Javed sir, for that detailed presentation. Just another reminder, as I said at the beginning of the call, any questions you have, some of you are already sending them across. just send them via the chat box to Farooq Karim Khan, and we will answer them. So I've already received a few questions, and I'm just trying to sort of bucket it into various themes, because there's quite a bit of repetition in terms of the questions. But what I can see is that there are around three segments where the questions are primarily coming from. I think one is around the investments and the interest rate impact that we are getting from the change in macroeconomic variables. The other is regarding UAE operations, and then there are some questions coming in around domestic operations as well. I'll start with the investment part of investment and interest rate impact questions. I think it was well covered in the slides, but just to ask you, can you please provide an interest rate sensitivity of 100 basis points change in interest rates, given the large size of the book, the fixed and floating book, and what will be the impact on equity and CAR and profitability?
So I think I covered extensively during the presentation. So our calculation, as I said it, our calculation shows that the 1% rise in interest rate would impact was something like 40 basis point, and our CAR has got enough cushion to absorb it. And then other question is that whether the interest rates are going to rise or not. That's also a question that has to be seen, because whether you have to see whether the monetary policy would be effective at a time when there is a supply shock, because most of the time it is the monetary policy is used to manage the demand side, but it's a supply shock. So I really don't know what would be the rate hike, but if the rate have to go up, I think we have got more than adequate cushion. And then I think it has to be seen with one very important aspect, how your overall income is going to go. So we are very comfortable with our profitability, that it is likely to be maintained because of the structure of our portfolio on the fixed bond, because on the fixed bond, there is a large maturity into 3 to 4 months. And by June, our current accounts are going to be almost equivalent to our fixed bond portfolio. So I think we are fully hedged on that part. So I think I see our earning to be fully protected. And when the earnings are fully protected, even after you can say when you pay the dividend and the whatever is left helps us to increase our CAR by 40 basis point. So that will offset. But the only difference would be that if rates were to go sharply up, say 3, 4% or 5%, so I think we are again quite covered for that kind of a situation. So I do not see any serious stress on our capital adequacy due to movement in the interest rates. And then, as I have told you earlier, any loss on the fixed bond portfolio is more than likely to be offset from the revaluation gains that we have got on the floaters. I think floater issuance is going to be very, very low, and the spreads are going to, go down further. So that's our assessment.
Okay, great. Just to follow on to that, there is a question on rising interest rate scenario, and what will UBL strategy be? Does the bank plan to reduce OMO positions? And also related to that, another question that the bank has booked 30 billion of capital gains in the March quarter, and is there a plan to sell further securities to book capital gains during the year?
So I think, as I've told you, that we would maintain, our asset side, which is our investments into, floaters and fixed bond. And any OMO retirement is likely to come from the growth in deposits. So we are quite neutral onto that. If we get more deposits, we will retire that, or we may make more investments. So I think it will depend. It would depend. So has anything changed in our strategy based on the potential risk of rate increase? The answer is no. So we are quite neutral, and we would look at what kind of opportunities come up. Frankly, we would rather be eager to invest if the opportunities to arise. So if there is opportunity on any side, we will rather be happy to invest more. So that's primarily our goal. But again, it will depend what kind of opportunities come up and how we would respond, that we really don't know. I think it's something we will see and then we will decide according to the situation. And the second question, sorry, can you repeat it? I think there are two parts.
Again, there's a capital gains outlook on capital gains.
I think, again, we do not follow any set pattern. We really don't know whether we would realize more gains or we will sell security or will not sell some security. To be honest, I'm not aware of. So again, it will depend on the situation, what we are going to take action. So only we are not aware of it, what we are going to do tomorrow.
Okay. And there's also a question with regards to the March profits being mostly driven from security selling. And how will you cater for it with a decrease in revaluation surplus?
So as I think I have explained clearly, so the March quarter earnings, you have to see it 2-3 ways. First of all, you can see the numbers by stripping the capital gains. So if you strip the capital gains, if you see our net interest income was strong. So that if you see that point of time, to be honest, that number itself strong. Our NII is quite protected going forward as well. Maybe a small you can say change, not any significant in my opinion. So capital gain, again, we don't know whether we'll have it or will not have it. Non-interest income is decent. So it's fine. I don't think that our net income is going to change by anything significant. If the interest rates to go up sharply, yes, there will be some you can say adjustment period before the floaters are repriced. So that will, you can say, that we will take a certain hit on our earnings. Say, for example, if the rates to go up by 1%, we would be losing about roughly 7-8 billion on our floaters. But I think when the rate comes down, we will be making up that on that net interest income. So it will be just a timing differences, not a true kind of a loss. So our standalone results without you can say without capital gains are strong enough, and we are in line with our expectations and our own goals.
So I think, again, a lot of similar questions on the investment side. So I won't keep asking the same thing. Just one strand of questions on which I think is regarding the interest rate swaps, particularly with Jazz, and the impact of those, given that interest rates are now higher. Any comments on that?
So I think, first of all, we have to say the Jazz transaction was worth 75 billion rupees, and these are the, you can say, the average tenor was 7 years. So 5 year, and then 7 years. The total will be the average tenor of the transaction is 6 years. So I think you have to see this kind of transaction not over a period of 6 months. If the period is 6 years, you have to see that you have to forecast the average 6 year interest rate projection. Yes, if the interest rates were to remain, you can first to go up and then remain high for 6 years, definitely you are going to make a loss on it, right? But if, for example, in the last, we have undertaken this transition for some time, the rates are set. So we have made some money on the first part of this thing. So there is a possibility we might lose for 3, 4, 5 quarters. If we lose, and then probably we'll be making money again. So I think we used it as more as a hedging than of a outright, you can say, bet on the interest rates. And by 6 months, 8 months, we will have, you can say, 75 billion rupees of this swap would be, you can say, generated through our current accounts and fully hedged. So I think, again, this amount is not, if you have to see the total context, 75 billion rupees in a total context of our balance sheet in terms of our current account or in terms of our fixed income portfolio, is amount is not really large enough to be you can say to be concerned of.
Okay, I think with regards to the investment questions, that covers most of the ground. I'll move to the UAE operations, and in terms of UAE operations, we have a sort of a strand of questions there. Again, you did speak about the situation and the composition of the book. There are also questions on what is the growth outlook for UBL in that region, and of course, there's been very strong growth in the past. So, does that strategy questions on that strategy?
So I think our growth was very strong. we had a growth until this quarter, but now that growth has stopped, and there is also possibility of some of our deposits may be going away. So if at this point in time, it will be very difficult to state what again how long the war goes on. But I think if you ask me today, I will see 10 to 15%. There's a possibility of reduction in this quarter. In this quarter on the and if we are unable to you can say generate more deposits, what's happening is some of the deposits may be going out, and but some of the new deposits are also coming in. So the growth is definitely, as you can't maintain, it's a war-like situation. Different people would be reacting differently. Some of them may be transferring to safe havens. So again, it's all possible. Some of people would be moving money out. So if the war stops, then I think the growth would come back. May not be as strong as it was in the past, but definitely the growth would be there. We have established a fairly large team over there. We are establishing a 7th branch, and soon we would be establishing the 8th branch. So we are focused on the growth, but definitely the situation, the war has changed the dynamics. So the growth would go down. But again, we have to see it from the total context of the bank. Now GCC is just 12% of our total balance sheet. Sorry, in total our income side, the 12%. And the first quarter has been strong. This quarter also looks strong, but I think if there were to be dip in this profitability, say from 12%, it goes down to 6%, we are not really concerned because we would try to make it up through our you can say domestic operation. So our domestic operation is fairly large. Yes, the GCC, the impact of GCC would be on our growth, but it's fine. I think this kind of situation you cannot predict, and this is something it's out of our control. So we are just focusing on what we control. We are not focusing on what we cannot control. So again, a lot of questions can only be answered with the time, and I think it would be quite premature to comment on anything with a certainty.
Okay, sure. I'll move on to the questions that are coming through on the domestic operations of UBL. So one question that we got was that there was a significant increase in deposits in 2025. It was driven by institutional deposits as well. And could you please elaborate on this trend?
So I think again, as I said, majority of the large deposits are with the institutions. You have to understand it. The large corporates which are flush with the liquidity, they have got a lot of huge institutional deposits. They are all rate sensitive, and it's not a kind of a relationship kind of deposits. Majority of the deposit, it's not a kind of relationship deposit that no one has a perpetual relationship in this business. So I think it will all depend what kind of rate they get. So there is some impact of marketing to these kind of customers. But at the end of the day, a lot of deposit is a hard deposit. So someday it may be with us and it may not be with us. So again, our strategy is very clear. We will take the deposits when it makes sense for us, and we would follow this strategy. We are not obsessed with having a number 1 position into deposits or number 2 or number 3. We are fine to whatever number it comes up. So we are not obsessed with this deposit. So this is not part of our, even frankly, it's not out of our strategy as well. This is I would call it a randomness.
Sure. With regards to branch expansion as well, there are a few questions. Strong branch expansion last year, and there are questions around the branch expansion targets for 2026.
UBL is a kind of bank which does not operate on too many targets. So we operate on the kind of opportunities available. The branch operations we did you can say aggressively, but I think we lost a bit of money last year. These new branches, because they take time, and when they take time, you make losses as well. So we made about 4 billion loss onto these branches last year. So we are watching the situation closely. We are definitely looking for a high potential places where we can place a branch. So we would continue to look out for those kind of branches. We do not operate by target. If I get opportunity to open the right kind of branches, which can turn into profits quickly, so definitely we will go for it. So I cannot put the numbers. It will all depend on what kind of a potential location we get on, where we can, you can say, the branches, we will open the branches if these become profitable fast. Because at the same time, we are also mindful that the digitally, you can say, market is penetrating through digital means. Our network is now robust. So we will be looking for opportunities only at high potential locations. So we are at lookout for those, and it will depend what kind of opportunity you get.
Okay. And with regards to Islamic expansion and conversion, also there are a few questions regarding Alameen and what is the conversion plan to Islamic?
We have seen a very strong growth in our Islamic footprint. We have, as I think everybody almost knows now, that we have converted entire KPK and Balochistan, and then we have set up, you can say, branches in few cities. So right now we're close to something, if I remember correctly, something like 750 Islamic branches. That is you can say, a very strong business we have got, and that is being run independently. And we will continue to focus on this business. And on the conversion into industry. So if the industry has to convert, we are fully prepared for that. So it will all depend if it translates into, you can say, by 2028, if we have to convert all branches into Islamic, we are fully prepared. We have already, you can say, ran the experiment in this, not experiment, the actual conversion of all KPK and Balochistan branches. We did it successfully, but if we have to do it, we can do it very, very fast. So it will all depend on that, what kind of, you can say, how the environment unfolds. But the answer is we are prepared to convert. If these have to be converted, we would convert them.
Okay. Okay. And there's some question around cost to income as well. I tied in with the question around admin growth, that UBL had a 37% increase in admin in 2025. And were there any one-offs in this expense, some kind of trend going forward?
I think there's no one-off. Only in the last quarter, you can say, we had a amortization of our
Amortization of intangible of 4.6 billion.
Yeah, amortization of intangible when we acquired the silk. So we have to, you can say, amortize it over a period of time. So last year we did it in December. So again, this is the expense, whether we do it monthly or we do it one time in a year. So that was something like, how much, Manzoor, it was last quarter, 2020?
It was 4.6 billion because we amortized it one time for the entire 10 months period.
Yeah, so it was because we acquired silk in the March. So the amortization period was something like 10 months and few days. So it was 4.6 billion. The charge would come up something like 5.5 billion or so for the entire 12 months. So probably we would be charging it out in 2026 last quarter, as we did last year. But at the same time, I can say the costs are increasing generally because there is a high inflation in the country, and the costs have gone up. And this is the one area where we are concerned, but frankly, we can't help much.
Sure. With regards to dividend payout and dividend sustainability, there's a question on guidance of payouts going forward, particularly in a rising interest rate environment.
So I think probably I'll give you the answer in two ways. First of all, I mean, even before this situation happened in Pakistan, a lot of people were talking about our dividend policy and when we would be increasing the dividends. So I think you have to see from our dividend, you have to see it, what kind of dividend we used to pay in 2021. And then you saw a significant jump in 2023. And then there was a weight we did increase in 2025. So I think now any increase that has to take place will be sometime in 2027, inshallah, if all things remain in control, nothing something significant adverse happens. So that would be the time we would be looking to. And I really don't know whether we would consider it early part of 2027, or we'll do it in the middle, or we'll do it depending on what the situation. we plan to maintain this dividend, even if as I have explained to you, even with the rising interest rate environment, our net interest income is fairly protected, number one, for 2026. And in 2027, our current account would be higher than the fixed income portfolio. So actually, if the interest rates were to rise, we would expect our earnings to be higher in 2027. So I think on that count, we do not see an issue at this point in time with our maintaining our dividends. Capital adequacy, I think we have addressed that we do not see any significant pressure. And again, the one thing which is missing link is whether we have to take any provision onto the GCC portfolio. So that would be another thing. So at this point in time, I do not see any significant provision. But if there were to be provisions, we are also going to see a lot more recoveries from our silk-linked portfolio as well. We are expecting one fairly large recovery on the silk portfolio, so that may be cushioning us a little bit if some provisions were to be made into the GCC. And so I think, to be honest, I do not see any issue with maintaining our payout, or you can say at this point in time, based on information, all information I have got, and depending on you can say the situation, I'm comfortable at this point in time. But all I'm talking about that if the scenarios remain very reasonable, and a reasonable means remain in the tolerance limit, which can be sustained at $100 a barrel oil. I think in that scenario, the answer is yes. So at this point in time, our inflation forecast with $100 a barrel oil is, I think we consider it to be a very tolerable and we think situation to be manageable.
Sure. Okay. There's one question which referred to, I think, something that you mentioned on the slide around floater PIBs, that there's an 8 billion loss on floater in PNL in case interest rates go up. The question is it for a 1% increase? The 8 billion, I think you mentioned that while speaking.
Yeah, I think it's for a 1% if the rate for go. Again, it depends how the rate quickly move up. So if the rates move up in one go, or rates will move up in which you can say point in time. As I have told you that our portfolio is quite staggered. So if the 1% rate goes up, so which means that our repricing will take time, and then when the other you can say exactly what's the time when the other 1% goes up. So it will all depend what kind of time. But I think the maximum impact on this, if the rate should go up 3%, so it will be say 24 billion. So, but I think that's fine. That's a number. Again, we have generated a capital gain of say 30 billion. So I think those kind of 30 billion, I think it was even higher, 31 billion. So 31 billion is working as a cushion. So if we have to, you can say if the rates should go up say 3% in the worst case scenario, or some scenario. So if the rates were to go 4% even, so I think we have again created a capital gain enough to protect our earnings. So I think we have taken a proactive measure already in this regard.
Okay. I think most of the questions have been answered that I have been receiving. I think around the interest rate impacts, the UAE operations as well, and the domestic operations as well. And I think we're almost approaching, we have 5, 7, 8 minutes left to the hour. Javed, would you have any concluding remarks before?
Yeah, I think I would like to see in a few aspects. We are satisfied on the capital adequacy because there is a huge cushion of 4.6% at this point in time. Number one. Number two, we are seeing that our total revenues are going to be there, which we expect to be higher than last year, and our net interest income is going to be there. We have created a capital gain of 31 billion to have a buffer in case we have to make some losses on the floaters. So looking into everything, I think we are quite comfortable. Our priority of order is to protect the bank capital, so that is our number one goal. So that the capital is compliant, we meet all the regulatory requirements, so that everyone in the board, in the management is very, very mindful that we have to manage this, number one. Number two, our major goal is to focusing on our core business. With the core business as a growth in Pakistan. So that's our core business. GCC, you can say we want to grow over there, but again, it will all depend how the situation unfolds when the war ends. So our focus is on the growth in GCC, but it will all depend when the war closes. And GCC is about 12% of our operations. So that's the area of focus. And then we want to maintain the payout at this point in time. We are not looking for any dividend step up or any dividend reduction at this point in time. We are comfortable with the capital, and we would like to create more buffer in our capital. So I think 2027 would be the right time when we would be considering any change in our dividend. And we are focusing on our customers. I think you might have seen the ad which came in newspapers today, and I would say I'm personally truly proud of our you can say our hiring of a lot of people. Our average age of our permanent employee is just 32 years, 32 years in the bank, and we have hired 6,000 people and these are the people who have joined without any degree, whether just a metric or intermediate qualification. These are people which have come up with a lot of energy and a lot of hunger, and these people have done a great job. They're doing a great job, and we are very proud on this thing. This is, I think, more than numbers or more than anything else. I think if I look at the past 3 years, so these are the achievements which I'm truly proud of. Truly proud of, you can say, our entire team, that we have been able to make a difference in our society. Our outreach has increased through new branches. We have invested a lot of money, and I think indirectly we've also generated a lot of jobs as well. So we are very, very proud of this work. Thank you very much. Thank you.
Thank you very much. We have a couple of minutes. I just got this question from actually two analysts, so I thought I'll just ask it of you. The view on interest rates, any view on interest rates that you would like to share?
So again, it will all depend. If the war to close too soon, I think there may be a very little increase in the interest rate, if there is to be an interest rate change, right? If the war to increase, if the war to end fast, right? But if the war lengthens, definitely the rate would increase. But again, it would monetary policy. I think committee would decide that how they want to, you can say, take it forward. I think that at this point in time, whatever we are statistics, I think you and I are looking at everyone is looking at the same data. We are all hoping the war will end soon, especially the midterm election, and the US are there. So I think there is a will on the part of USA as well. There appears to be a will on the Iran side as well. But again, I'm not an expert, and I cannot really forecast these kind of events. So I think my hope is the war would end, and then I think there may not be potentially any significant increase in the interest rates. So I don't know. That's my wish or that's my analysis. So only the time is going to tell what happens on that side, right? So my bet at this point in time, if there is a rate increase, it is going to be somewhere around 50 basis point to somewhere 100 basis point. Initially, I think the central bank probably would be mindful of the supply shock.
Sure. I think that covers most of the questions that we received. Thank you, Javed Saab, for that very comprehensive presentation as well as Q&A, and thank you, Manzoor and Munawar as well, for joining us. And thank you to our audience, the analysts and the fund managers and the investors. If there are any questions which you further have based on our results, just feel free to contact our investor relations team for that. Thank you, everyone.
Thank you and have a great day.